Now, if you notice the graphic we put up when we were teasing Samson Esemuede coming on the show, you notice the topic is we've been spending most of our lives living in a fund manager's paradise. Now, we're going to explain that. For the young people out there, this is inspired by a song from 1995 by Coolio, very popular song called Gangsta's Paradise. So here's a clip in case you've forgotten. That's it. If you don't remember, Google it, take a listen. Now, Samson Esemuede joins us. But before we get to Samson, what are we talking about? The NGX. So far, as of yesterday, it's up almost 30%. Yeah, 29.41% year to date. And if you look at the climb in the all-share index over the last 10 days, I mean, it's just going up and up and up and up. And we are happy to get into the weeds and discuss the stock market with Samson Esemuede, who is the Chief Investment Officer at Zrosk Investment Management. Samson, it's good to see you again.
Good to see you, Rutus.
Welcome back to the show. Last time you were on, it was September. We're talking about your equity fund. You know, it's great to have you. So Samson, look, and by the way, you are a prominent fixed feature on the Drinks and Mikes podcast, which just had their finale earlier this week, and they're always getting your insights there. So shout out to Nairametrics, Ugodre, and everybody at that great podcast, which you add your wisdom to. So
thank you.
Bull markets.
Sure.
You, of course, last time we started your fund, I can imagine the funds in your equity fund have taken off.
Yes.
How are you? Do you take profits now? What's your strategy? Just tell me how you are reacting to this.
So I think in emerging markets, I think we often underestimate that the political economy are very significant for the market direction, right? And also within emerging markets and frontier markets with Nigeria is return period clusters. Yeah. So you have periods of excessively high return, and then you do have period of high volatility and low return. I think at the time when we discussed, we're coming out of a high volatility, low return environment. And the cross of the fund was actually, I think there's a high probability that we're entering into a high return environment,
and we're right.
And that is what has happened. Yeah. And the fund has basically doubled since we launched in September in terms of performance. In terms of AUM, it's gone up about close to 600%, so 6 times.
Wow.
Right. So the narrative is very, very strong. And you have to also remember that there are fundamental factors, and we can discuss in details what those are if you have time. But there are also significant technical factors. This is an asset class that is largely over-owned by every pool of money that there is, right? So put things in context. The collective investment scheme in Nigeria is about 4 trillion AUM.
That's Naira?
Naira, yes. The amount invested in equity funds is less than 50 billion.
Wow.
Right? So no one owns this asset. So what you are seeing is a shift away from, and the equity market over the last 3 years has shown very, very strong returns. So people are looking at the market and realizing that equity has consistently beaten fixed income money market yields. And obviously the asset class of choice for most Nigerians is the US dollar.
Right.
And it has outperformed the US dollar.
Right.
So within the context of that, people are now shifting assets. And this is just the CIS. You look at the pension schemes, depending on the RSAs, but on average, pension funds are allowed to invest up to 25% of their assets in equities. The average investment today is around 10%, and that is usually concentrated in a few PFAs. A lot of PFAs are basically large fixed income funds. So you're starting to, and they also have this mentality where they kind of herd and they peer. So when you have the guys who are overweight on equity outperforming, everyone chases, right? You add that to the fact that yields in the fixed income market has also gone down, right? And the DMO is issuing less and less securities. So by doing that, there's a huge wall of liquidity that is coming. Is not finding fixed income assets to buy. So that capital is going into the equity market. And then finally, the foreigners, right? They de-risk significantly in Nigeria. At the height of the last cycle, we had between 16 to 17 billion in foreign ownership of Nigerian free floats. Right? As at 2023, when I was looking at data to launch my fund, this number was around 2 billion.
Oh, wow.
Right? So there's been significant, so nobody owns this asset. These assets are very, very cheap. And then you then have a fundamental macro improvement that is bringing the cost of equity down.
Like stability in FX and
so stability in FX. So let's put this in context. So when you think about earnings, right? I always say a dollar is a dollar regardless of where it is earned.
Right.
In Nigeria, when you had significant risk around the FX, as an analyst, you are thinking in dollar terms, what is this earnings in this company that I forecast in the future going to be worth? And when there's a high probability of significant devaluation because of the market distortions that we had, you put a high risk factor on that naira coming.
Right.
That risk factor is gone. So it then means that the cost of capital you are applying to assets in Nigeria implied is declining.
Gotcha.
When you do that, you were an analyst in your past life. When you run your DCF, your denominator.
Discounted, Samson, discounted cash flow analysis.
So when you run your discounted cash flow analysis, at the bottom is usually your cost of capital.
Right.
When you do your sensitivity, if you move that cost of capital,
then that means
it explodes.
Yeah.
What we are seeing in real time, right? Because sometimes it's very hard to move from spreadsheet into the real life.
Yes.
But what we are seeing in real time is that cost of capital just edging lower.
Yeah.
And that is what is exploding asset performance in fixed income and in equities.
Fantastic. Now, what's your strategy now? What you've said has come to pass. You're doing, I didn't know it was a 600% return. That is incredible.
No, not 600%. 600% growth in the fund and 100% return.
Fantastic. Yeah. Thanks for the clarity. Yeah. Now, what's your strategy? I mean, now we're in the middle of the run. We have the chart there over the last 10 days. So are you going to... I don't want to expose your secrets.
No.
What's your strategy? What do you do now?
You're always very nervous,
Yeah.
right, when the market is on a bull tier,
Yeah.
right? However, what we do is that we continue to check whether the structural factors driving the market is still intact.
Okay.
And to a large extent, we think it is,
Yeah.
right? So FX is likely to remain stable. Oil revenues is likely to improve. The take of oil revenues that flows to the fiscal federation and by extension the reserve is likely to improve. Earnings are likely to surprise apart from banks.
Okay.
I think there's risk to bank earnings because of forbearance.
Right.
So I am doing what I call portfolio reallocation,
okay,
as opposed to reduction in risk and profit taking.
So you're just moving from one
sectors into the other, because I think consumers look really interesting, so I'm kind of adding risk to consumer. I don't think it is the time to significantly reduce risk in the market because of the factors that I mentioned earlier. Because when you sell, what do you buy? Right? Because you just have cash. You just have cash. I mean, cash earns a decent return, but that return has gone down. And the numbers are strong. These businesses are improving, because what is also happening is that a lot of businesses during the lean period have cut out a lot of fat. Right. So now you are seeing pricing come back, you are seeing volumes come back, and then these companies, because of how bad the previous cycle was, are afraid to spend in investments. So the free cash generation of businesses are very, very high. So we are in a very high cash generative period, which in turn translates into high dividend payment. So what I'm doing is just reallocating. I think short term there might be risks to banking sector earnings, but I still think that for the select banks that have very strong core earnings, they will be fine and they will go through this period easily, but some banks might be handicapped. So that is what is driving my views.
Perfect. You've taken me to the idea of shorting stocks if you think that one sector is going to have an issue. Can you just define what shorting is and whether or not you can apply that to
Nigeria? So basically, the concept of shorting is basically selling a security that you don't own. Right? And the idea is to be able to take advantage of market pricing when you think it has gone ahead of itself. In reality, how does that work? Right? You borrow the stock from your broker because you don't own it, and then you sell it into the market. Right? Let's say you sell it at 100, and then because you think the stock is overvalued, the stock goes down to 80. You then go back to the market, you buy it at 80. Right, and then you return the stock that you borrowed to the broker, and you make your 20 naira profit. So it's the opposite of buying that has been basically created, right, which is the shorting mechanism. But you need to get the borrow. There's a concept of naked shorts, which basically means there are some exchanges. It's very difficult for that to apply in Nigeria, where you can basically short in the market without having that borrow requirement. The risk of that is if you don't have the stock to deliver, it will lead to settlement failure and market failure. So a lot of jurisdiction tightly regulates the ability to go short naked. You have to be covered. And the concept of covering is borrowing the stock from your broker before you engage in the sale.
Thank you for that. Thank you for that. And it does happen in
So we have the mechanisms to short in Nigeria. I think there is an education problem around, because the reason why, where do you get the stock to borrow?
Right.
So I have strategic equity positions that I probably never going to sell, right? So you can earn extra income by lending your stock out. So if I have a big position in GT, for example, and I know I'm not going to sell GT over the next 12 months, a broker can come to me and say, do you want to borrow your GT bank stock for somebody else that wants to short it?
Right.
He will pay me a fee for that. So it's a yield enhancement strategy for me. So I get an income. I'm still benefiting from my capital appreciation and my dividend, but there's a financing income that I earn as a result of borrowing my stock to the broker. I don't think the education around that income and the mechanism to properly price that is being built. I mean, I had a conversation with Stanbic Securities Lending team around this process, and they are quite advanced in that conversation. But for it to work at scale, you need asset managers, pension funds to be willing to participate in the pool. But the mechanism exists. You can borrow, you can sell short, but the practice is quite low because of education.
See, this is why we had you on the show. So fantastic stuff. Let's get to the banks. You mentioned the banks a moment ago. Does the recapitalization exercise, March 2026 is the deadline. Governor Cardoso of the Central Bank at the last Monetary Policy Committee meeting, he said, where they held rates, said that 8 banks have hit and they're expecting more. What does it make banking stocks more attractive? You were a little cautious there when you mentioned banks. How are you seeing that?
So I think at the time, the narrow definition of capital that the CBN applied was a problem for me, right? In hindsight, I understand why they did what they did, right? Because largely there were question marks around, I think, around quality of bank earnings, right? And so they needed fresh equity. And the reason they needed fresh equity is that they needed the system to be able to deal with the forbearance issue that was in the banking system. I think this is a positive for the market because as analysts, when there is uncertainty, you price in the worst case scenario, which is why you have companies trading at 20%, 30% the value of what they say their net asset is worth, which is crazy, right? But the reason is because there was uncertainty and lack of knowledge around the quality of banking books. What the CBN is doing by forcing the banking system to raise capital and taking the hit and cleaning up the forbearance is that as an investor, you have a lot more confidence on the quality of the books that the bank present to you. That has to be positive for the system, and that is why I am not surprised that the banks who have successfully done this and have provided the necessary disclosure has done as well as they have.
What about insurance? So the recapitalization. I mean, it's not as where banks are.
It's not as advanced. The need for capital. I think. For the insurance sector, the last time there was a recapitalization exercise, I think, was like over 20 years ago. So that industry is undercapitalized, and so in dollar terms, when you look at the new capital requirement, it's kind of even still lower than the initial capital 20 years ago. So they need to be recapitalized to be able to take risk, right? When you think about financial industry, you have pillars, right? You have the banking system, you have the asset aggregators, which is basically the pension funds and the asset manager, and you have the insurance company. And usually in developed markets, you have these 3 pillars of having quite big sizes. I think the total gross written premium in the insurance industry is probably 2 or 3% of the total assets of the banking sector. So clearly that industry is under indexing significantly, and I think this recapitalization exercise should help force a bit of consolidation and then them investing in the systems and the process to allow them to price insurance risk properly, which would then allow them to scale. Right, but I always say with insurance, you have to have assets that you want to protect to insure. So the insurance is always tied to economic growth. I'm confident that we can kickstart an investment cycle in Nigeria, and I think overall I'm positive on the outlook for the sector.
All right. Gosh, we're almost out of time, Samson.
There's so much.
Give me your outlook for the market. Just, I guess, to close out the year.
The local market?
Yeah, please.
Okay. I think equity still should continue to perform very, very strongly because what we are seeing is a significant reduction in cost of equity that is driven by macro stabilization, right? And inflation is also ticking downwards. And remember, inflation fits into your cost of capital as well.
Right.
And so you see stable exchange rate, declining inflation, improvement in banking sector earnings. That is Goldilocks scenario for stocks, right? And so I remain positive on stocks. On fixed income, it looks like the fixed income market has gone ahead of itself, right? Yields have collapsed from like 24% on NTB to 15.8% at the last auction that I saw. So there is risk of reversals in the fixed income market over the short term. So you have to be cognizant of that. So from an asset allocation standpoint, I think we are significantly overweight equity. We are still positive on the OMO. We are a bit negative on NTB, and we are neutral on bonds.
Fantastic stuff. Samson Esemuede, Chief Investment Officer at Zrosk. I gotta have you on again. Always a pleasure having you. It's just such an informative discussion when you come on. Thanks for your time. Really.
Thank you.